Hello, welcome back. I hope you are having an awesome weekend. Now, today we're going to be taking a look at a company that had a massive crash. That is Twilio, and you'll see that it is down 35%. That was last Friday. Now, come Monday, we want to take a look at this company, kind of examine what it is doing financially and whether it's a potential buy right now after it has fallen down so much 90% almost. Take a look at this one. Its 1 year high has been 317. If you take it back 5 years, take a look at this chart. Absolute annihilation here. And we have talked about this company when it was more expensive, and I have urged that this wasn't a good buy. It did look like this company would be going down because it was overvalued. Now, is this still the case? We're going to be taking a look at this in this video, of course. But first things first, let's take a look at what happened during the earnings report. I have it here. So shares plans 34% on light guidance seems to be the big problem, which is generally speaking a fairly important issue for these companies that are not really making money, or at least they're not making enough money for their valuation. And when they get light guidance, it means that they are likely not going to be making a lot of revenue or not a lot of net income in the upcoming 1 or 2 or 3 years, something of that sort. And so investors tend to pretty much get away from these and kind of sell them immediately. Now, you will see here that the company added about 5,000 active customer accounts in the quarter, and again, guidance was softer than the analysts were looking for. Now, let's take a look at what the company did. A loss of 27 cents per share. That is adjusted even. And when you're looking at an adjusted loss, that is even more weird because when we're talking about adjusted, typically companies use something like EBITDA, for example. So they already exclude a lot of the expenses when they adjust for this. So the actual loss could actually be higher. We're going to be taking a little bit of a look at what the company has been doing overall, just to get a sense of what is this kind of adjusted earning loss per share over here. Now, the analysts were expecting 36 cents per share versus that was the versus pretty much. So they did better than expected over here. In terms of revenue, also better than expected, almost 983 million versus 972.2 that was expected over here. And of course, as you can understand, this is a bit here. It's just the guidance that really destroyed the company. And again, you can imagine when a company is overpriced that much, it can go down like 40% just on light guidance, as you'll see with this one. Now, they're calling for an adjusted net loss of 11 cents to 6 cents per share, which frankly, taking a look at what the company has been doing before that, it doesn't look that weird. It would look sort of like expected, and close to about $1 billion in revenue over here is the average. Now, they did expect an adjusted loss of 12 cents per share on 1.07 billion in revenue. So it's basically just the revenue that kind of destroyed this. And again, it's not to say that it's the revenue alone that destroyed this. Now, as we're entering a recessionary environment currently in the overall economy, a lot of people are actually going to be looking to dump these kinds of companies that are not really making money. They can possibly go down even more. So they're a liability for investors, and this is why they tend to drop them like immediately, especially when there is something that doesn't look right. Even the slightest thing, they can completely be annihilated here. And as they said, like many companies, they are facing short-term headwinds, expected again, but the long-term opportunity remains strong, is what they are saying here. The company's revenue grew 33% year over year, which is fairly solid, actually, and compared with the 41% in the second quarter. Now, the Twilio also said it had over 280,000 customers, active customer accounts at the end of the third quarter, which is up like 5,000 customers over here. Now, again, this company has been completely annihilated. They have announced that they are cutting 11% of their workforce as well, and over 800 will leave the company in the fourth quarter. Now, let's take a look at the financials and see why. Why is this going down so much? Now, you will see here is something to be expected from these kinds of companies. Again, this is not making money. No net income, no free cash flow. So things are looking really bad here. Plus, the company is issuing a ton of shares. So the most important things that you don't like to see are the first things that you see here, and this is why you can see this kind of insane decline over here. And you are seeing declines in a lot of companies. Like, for example, Facebook is also going down quite significantly. It has gone down a lot. But the big, huge actually difference is that Facebook is making a ton of money. Same thing with other companies like Intel as well, or many others. But when we're looking at these companies, these are insanely weird companies to hold right now. Is insanely risky because of the money loss and because of the uncertainty for their future. You don't know how they're gonna be doing, and when they are overpriced that much, and they're not making any money, what's to get here, what's to buy, frankly. And it's the revenue growth that has been growing pretty nicely over here, as you'll see, that has been getting better and better. Net income, though, again, you'll see free cash flow, precipitous decline over here. Doesn't look to be getting better. It's actually looking to be getting worse. And it's only the total equity that is going down typically with these kinds of companies because they are issuing shares. And this is how they're funding themselves pretty much. Again, not much to see here. The company doesn't have a lot of debt. At least that's something. That's definitely something good. But if we take a look at the financial statements, you'll see what is happening with this company. And fairly quickly, you will be able to see that their revenue is actually pretty much increasing. I'm having some issues here with my internet connection, it looks like. Let me pause it a little bit. Okay, I think it's back. Okay, so the revenue over here, 400 million to 2.8 billion over here. And you will see that the net income, again, it's declining and declining more and more every year, losing 1 billion back in 2021. And taking a look at the balance sheet kind of tells you the same story here. The thing that we already examined, it's the additional paid in capital. Look at this, 13 billion, 9 billion, 4.9 billion. It's just selling, pretty much issuing shares in order to make some money. And even though they are issuing 13 billion, 9 billion, 4 billion, their total equity is currently sitting at 11 billion. So imagine that, how much money they are losing through the years. This is looking really bad. And in terms of the cash flow statement, you will see the same story, going down and down and down in net income, and then some adjustments which bring the operating cash flow still under negative territory even for after the adjustments. And if you take a look at the free cash flow, again being under negative territory, something that you hate to see with all the common stock that's being issued from the company, and basically the debt that they are starting to get as well, like other financing activities. You'll see some extra debt starting to pile up here. So things are not looking great at all here for the company. Now, in some situations, you could potentially maybe buy a company of this sort just for the insane growth that it could have through the years, and if it's super cheap. Like if you can get it at a super cheap price, then it may be worth it. And this is where the tool can help you here. Our tool can actually definitely help you. Remember that you can gain access to our stock evaluation tool and everything that you see here by becoming a Patreon. All the links in the description box below this video. But what we can do here is project what the company could potentially do in its future. Let's just say that it's going to be achieving 20, 30, and 40% of revenue growth every year for the next 5 years. This is a little bit too high, but let's just say that this is going to be the case. Now, you will see that the net income margins for the company have been negative because they are not making money. Yet, when you want to be using a cash flow model, you want to have at least some marginal profitability. So even though the company doesn't look to be achieving that anytime soon, frankly, things are going worse and worse, frankly, we still have to assume some marginal profitability here. So let's just go 1, 3, and 5%. And this will serve us in order to understand what is potentially to buy the company for today. If it were too cheap, maybe it makes some sense to buy it for the very long run, maybe. But it would have to be like super cheap. So let's. This is what we're doing in this kind of tool here with this kind of company, because otherwise there is no buying this one based on what they are doing financially. Now, free cash flow margins, again, we don't have something that we can use because the company's free cash flow has been negative and it's coming from negative net income. So I'm going to be using something that the companies typically make 80, 90, and 100 percent of their net income becomes their margin of their free cash flow. And let's just say that the annual return that I want to get is 13%, which is the typical one that I ask for. And I hit calculate. So let's see what's going on here. And what is interesting here is that in our high estimates over here, we are looking at a price of $48 with the current price sitting at 42. And even after this for almost 40% decline and a total of 90% decline, our low and medium prices are still very low and much more expensive than the current price, which is again 42.74. You can see it here as well. And you can understand that this means that the company is still very, very expensive for what it is, even if all these were to come true. So in order for this to be a potential buy, the current price of the stock would have to be something like $3, $4, something of that sort. This would potentially make some sense, and even then it would be risky. But at $42, there's just no buying this one. It's just a lottery ticket that you would have to find some people that are willing to be to be buying this at these insane valuations in the future. Maybe when the market reaches another exuberance phase. But right now, this one is just definitely not a buy as it is today. Thank you for watching this video. I hope you enjoyed this one, and please remember to leave a like and subscribe. I'll see you soon in the next one. Bye bye.